1875 Edwards, it reflects your amount standardized rate per material or per kilogram or per unit is very lesser than the actual rate incurred when you purchase a raw material from the market. Alright, after two variances, next is material usage variances. Material usage variances is all about a comparisons of the particular quantity, how much amount of quantity has been varied. So now we'll need to identify the differences between the standard quantity and actual quantity multiplied with the standard rate or standard price. So standard rate into standard quantity minus actual quantity. This shows your how much amount of quantity has been actually usage and what is the variances regarding this difference. Start with this material A. We need to calculate one by one all material. So first is material A. Standard rate for material A is 15. Standard quantity is 600 minus actual quantity is 640. So here 15 into minus 40, it comes to minus 600, and that's why this answer is adverse. Here the company is using to manufacture 1 unit or 10 unit, as we have an example that is manufacturing for 10 units. Company actually standardized 600 quantity is required, but instead of 600 quantity, company use 640 quantity for the manufacturing of 10 units, and that's why they were using more quantity than the standard quantity. That's why their answer is adverse. So first is material A, then material B. Will identify whether it is adverse or a favorable concern. Let's see, the standard rate is 20. Standard quantity is 800, but the actual quantity is 950. That means the company used more quantity than but the company is actually using the quite higher than the actual standard quantity. That means they need actually 800 quantity only as per the calculation, as per the historical ideas, as per the predeterminations, but they used 150 quantity more than the standard, that is 950 quantity they used for the manufacturing of 10 units, and that's why their answer is adverse 3000. So in this case the company is having a negative impact through, it is not a completely negative impact, but it shows that how many quantity is required and how much quantity has been used. Here it is used little bit higher than the actual standardized. Now see, in case of material C, the standard rate is 25 and the standard quantity is required 1000 minus actual quantity they use 870. That means it's favorable because it shows the amount of quantity is required is more than the actual quantity used in the organization. So in this way we just have some positive impact in material C, and which comes to 20, just identify that is around 3250. Yes, 3250, that is favorable. And this way material C, we have some favorable situation because of the company use a lesser quantity for the manufacturing of 10 units than the standard quantity, and that's why their answer is favorable. Now let's just see the overall position of the material usage variance, whether the company is using a favorable situation or unfavorable situation. There are two materials which have an adverse situation, and the total of that adverse situation is 3600, where one is favorable, that is 3250. So in this way the total overall impact is negative by 350. So 350 is negative, and that's why overall material usage variance is minus 350. Now if you want to clarify and rectify whether your answer is accurate or not, we have another important shortcut to identify, or that we can tally our answer. MCV is equal to MPV plus MUV. MUV. Just see your previous answer. What was your answer in case of MPV? The MPV is 1875 adverse. Plus MUV is also 350 adverse. So the total of this is 2225, that is adverse. Just see your MCV, material cost variance, your first variances, and in the first variances your MCV is also 2225 adverse. Because of your standard cost is 50,000, your actual cost is 52,225. So the MCV is 2225 is adverse. So it is tallied. In this sense, your overall variances which you calculated are correct. So now the next variances is material mix variances. Material mix variances is all about the calculation of the certain quantity has been changed. That means company need to identify the revised standard quantity. And how the company can revise the standard quantity? There is a formula for calculating the revised standard quantity. And the revised standard quantity can be calculated with revised standard quantity. Formula is total actual quantity multiplied by the amount of standard quantity. Total actual quantity multiplied by standard quantity divided by total standard quantity. Now first we'll find out for material A. How much total standard actual quantity? It's 2460. This is a formula. What is the formula for MMV? That is revised standard quantity. Revised standard quantity minus actual quantity into standard rate, or standard price. This is your formula for material mix variances. But we don't have a revised standard quantity. We have a standard quantity, but revised standard quantity we don't have. So why it is required revised standard quantity? Because of there are three different materials. We don't have a one material, and we have three materials. That's why we need to calculate how much revised standard quantity on the basis of the total actual quantity and total standard quantity is concerned. And that's why we use this formula. So revised standard quantity would be calculated on the basis of this formula, that is total actual quantity into standard quantity, which we were actually identified, the standard quantity of the respected material, divided by total standard quantity. So 2460 is total actual quantity, multiplied by of material A, standard quantity is 600, divided by total standard quantity is 2400. The answer of the material A comes to 615 units. 615 units. So this is for material A. In the same way, we will identify for material B. Total actual quantity is 2460, multiplied by for material B standard quantity is 800, and the total quantity standard quantity is 2400. Your revised standard quantity for material B is 820 units. And for material C, again we'll have to calculate it in the same way. 2460 into 1000 divided by 2400, it comes to 1025 units. So this is a way to calculate first your revised standard quantity by the using of this formula. This is a formula where you can identify your revised standard quantity. and on the basis of this revised standard quantity we can calculate a material mix variance. Now we'll calculate the material mix variance one by one for all the materials. Let's start with the material A. Formula is here. Revised standard quantity for A is 615 units, which we were actually identified. So 615 units is revised standard quantity for material A, minus your actual quantity is 640 into your standard rate, and standard rate for material A is 15. So just identified that how much is concerned here. The difference is minus 25 into 15, and it comes to that 375. So 375 is adverse. Why 375 is adverse? Because of your revised standard quantity is still lesser than the actual quantity, and that's why minus 375, and your answer is adverse. So for material A, your revised standard quantity is lesser than the actual quantity, and that's why answer is adverse. Next is material B. In case of material B, your revised standard quantity is 820 units. Your revised standard quantity is 820 units, and your actual quantity is 950. It shows still adverse situation. Standard rate is 20. So the minus 130 into 20 comes to 2600 adverse. 2600 adverse. It shows in case of material B also your answer is adverse, because of your revised standard quantity is quite less than the actual quantity incurred. Now in case of material C, comes to revised standard quantity is 1025 minus your actual quantity is incurred is 870, and the standard rate is 25. That means it is around minus 155 multiplied by 25. 125 is positive. Why it's positive? Because of the standard revised quantity is quite higher than the actual quantity is used. It's almost have a difference is 155 units more. So 155 units is surplus. 155 units is surplus. That means it is reserve than the actual quantity has been used. And the standard rate is given, that's 25. So multiplication of this, that is 3875 favorable. 3875 favorable. So overall situation, it shows material C is 3875 favorable, material B is 2600 adverse, and material A is shows minus 375, that is adverse. That means material A and B have an adverse situation. The total is comes to 2975. So adverse is 2975 and favorable is 3875. The total position, it comes in favorable 900. So when you use the material mix variances, listen, this is also almost very much compared to material usage variance. If you have seen the material usage variance, your answer would be negative. That means adverse situation, 350 adverse. Here we are using a standard quantity, right? But in case of material mix variances, we are using a reverse and revised standard quantity, and as per the revised standard quantity, your answer it comes in favorable. That means the company is in a situation where they have a certain amount of favorable situation on the basis of if they compare the total mix variance, that means all materials quantity has been merged and calculated a mix variance, the situation would be favorable. This is what all about material mix variances. Now after material variances and labor variances, we'll move for the third variances, that is overhead variances. Overhead variances is all about the observation of overhead and overhead recovery rates. There are two types of overheads. One is the fixed overheads, another one is the variable overheads. We need to calculate all the overheads and have an estimations, or on the basis of an historical cost or a predetermined cost, maybe certain amount of assumptions to be kept by the managers or the persons who are actually looking after the overhead expenses. They just identify the what amount of overhead expenditures are incurred along with the amount of standards in their minds, and if there would be any variance and changes or the differentiate, then the differences would be identified and concerned with the taking a future path of decision. So here the company is using the overhead variances for controlling usage and the expenditures to be find out the how to reduce their cost and cost control. Let's see the questions which we are going to take it from the presentation area, and the question is, the following information was obtained from the records of a manufacturing firm using a standard costing system. For that, they asked to calculate two variances. One is variable overhead variances, that's one, and the another is fixed overhead variances. Under that, the expenditure variances, volume variances, efficiency variances, as well as calendar variances. So these are the variances they asked, and we will calculate all the variances one by one. For that, they offer one information in the bracket, that there are four information. One is number of units is given, that is actual standard units and actual units. Then the working days is given for also standard and actual, and then fixed overheads is given, what amount of fixed overheads they have and standardized as well as actual, as well as one more information is given, variable overheads, standard and actual. From this available informations, we will identify the some missing items as well as the items which are required for the calculation of variances. Let's begin with the first item that we might be required, that is standard fixed overhead rate. The standard fixed overhead rate per unit, it's required, and for that we need to calculate it. That's the first information. This is your working. And first is standard rate per unit, that is for fixed, standard rate for the fixed cost. Okay, and see the question, the total fixed overheads is given 40,000. So rupees 40,000, it's your fixed overheads, divided by your standard units. Standard units is, number of units is 4,000 units. So in this way, your standard fixed cost rate per unit comes to 10 rupees per unit. 10 rupees per unit. That's your first item which you identified. Now we will identify same way, standard variable overhead rate. Standard variable overhead rates per unit, and for that we need to identify how much variable expenses are given, 12,000 rupees. So 12,000 rupees divided by same 4,000 units, and it comes to rupees 3 per unit. So this is your second item which you would identify. Next is standard fixed overhead per day. Why it is required standard fixed overhead per day? Because of we need to calculate standard fixed overheads for the particular expenses. How much total standard expenses incurred per day? So that's why we find out first standard fixed overhead per day. Standard fixed overhead per day. The standard fixed overhead per day you can identify on the basis of units. We need to identify for units. Here, how many units is actually standardized? That is 4,000 units. And how many days is actually working in the particular institute? It's standardized. That is 20 days. So in this way, you have an answer that is 200 units per day. 200 units per day, because of 4,000 units has been used in 20 days, so the per day 200 units is required. Now if you want to identify the how much standard fixed overheads per day, standard fixed overheads per day in rupees, in value. That was in units, now it is in concern. So 200 units multiplied by 10 rupees per unit comes to 2000 rupees. Rupees 2000, it is standard fixed overheads per day in value. So these are the informations may be required for the calculation of overhead variances. Let's begin variances one by one, and here I am